Albertsons shares sank after the grocer warned consumers are pulling back on spending. Next week, we'll get more quarterly reports from several major consumer names, giving investors a snapshot on retail spending. Joining us now with more, Michael Zakkour, CEO at 5 New Digital and the author of The New Retail. Michael, great to have you with us.
Morning. Thanks for having me back.
Albertsons really seem to underscore what we know already about the consumer, and that is the K-shaped economy. Albertsons largely caters to the lower K. And what's interesting is how the company was talking about how they're dealing with those pressures, because they're basically saying that they would eat some of their margin in order to keep prices low, to keep those consumers coming back to the stores. What can you sort of extrapolate from that?
Yeah, no, I think, the Albertsons news is a bit of a bellwether for what's coming up and a little bit more action in retail earnings next week. And then obviously, third week of August being the real signs that we're looking for. But I think Albertsons is a good indicator that the consumer is finally starting to really feel the pinch, and they are changing their spending habits. In some cases, they're reducing. In other cases, they're reallocating. And, what Albertsons tells us is the top of the list, armies and families march on their stomach. And, the stubbornly high grocery prices combined with, continuing inflation, tariffs, there's a lot of headwinds, and we're expecting this to be, it could be a rough couple months here in the retail sector.
Do you think it's an Albertsons specific? And I know, Albertsons is not necessarily, the company that you focus on and specialize, but what they're saying is basically that they've got to keep those prices low. They're willing to make price investment or eat those costs. Where does that tell you the power lies? Because even if they're pushing back, they're saying that they're trying to push back on suppliers and they're working on that. But it seems to indicate a little bit of an upper hand to the food companies themselves, and maybe less of an upper hand for the distributors.
Yeah, for sure. And we've seen that, over the last couple of years, and whether it's tariffs and retailers and companies like Walmart and Target and others being willing to eat some of their own margin. I think they have to, and I think it's going to be a trend that continues through the rest of the retail earnings season, simply because people are being monetized to death. There are only so many times you can see the price go up, another hidden fee, whether it's in products, whether it's services, grocery. I mean, gas has been up and down all over the place. So I think Albertsons is doing the right thing here, and I think other retailers will follow suit, which is the consumer is at a breaking point. I've been incredibly surprised and delighted by the resilience of the U.S. consumer. We are up about 4% year over year. That's, accounting for a major trough last August. But, throughout the last 2 years, the American consumers kept spending. But I think we're starting to reach a breaking point, and I think these retailers having to eat margin are an indicator of that.
And you make the case, Michael, also that, the upper K, the wealthier consumers, higher household income, those are sort of masking some of the weakness that we are seeing in the consumer economy. And so there's different parts of the K. And so on the upper part of the K, the lower part of the upper K, I mean, we're seeing gas prices at $4 a gallon, et cetera. At what point do you start seeing that even that upper part of the K start to break a little bit?
Yeah, so it's not quite there yet. We do a lot of research and a lot of analysis here every day. And one of the things we have been tracking most closely over the last couple of years is the increasing percentage of consumption and consumer dollars that are supported by the top 20%. So right now, about 20% of all spending households in the U.S. are making about 80% of the product value purchases. That's not sustainable. And we're seeing it in everything from, even now it's touching outside of grocery and consumer products, but services, whether it's hotels and travel. So, yeah, there's a lot of masking here because those wealthier premium luxury consumers are really propping up the rest of the industry, but I think you're going to start to see a break there as well. Remember, luxury is a global business, and there are China concerns for luxury, there are U.S. concerns. As right now, I think it's going to hold, but I think we might see some trimming there as well in the next 6 months.
In terms of all the sort of economic indicators, what's the one thing that's going to make you doubt even that upper income consumer? I mean, obviously, it's not necessarily gas prices. I mean, is it higher mortgage rates, higher interest rates? What would it be?
Yeah, that's a great question. I think it's not going to be so much around mortgage rates or the price of groceries, but I think I think it might be a bit of a self-policing mechanism where, these spenders are going to realize, hey, look, we're not immune from the vagaries of the market as much as we thought we were, but they're also going to be sensitive to, we're not seeing it, but they could be sensitive to, you don't want to be driving your brand new Jaguar down a street full of 79 Pintos. So, I think that wealthy consumers can continue to prop up retail, but I think perception as well as some realities in terms of the tariffs and the ongoing situation with Iran, I think both of those could be breaking points even for the upper level consumer.
And what sorts of retailers will fare best, in your view, in this environment where there might be this sort of self-policing on the horizon?
Yeah. It's what's happening right now is, while all of this is happening, we're having all this new technology emerge and how AI is working into retail and the supply chain. And so when I look at companies like Walmart and Amazon in the retail sector, I feel really good about where they're going because they are built to be integrated online, offline, new retail companies. They're building the technology that's going to help them save money and get through the efficiencies. So I think what we're going to see here is consolidation at the top of retail in the same way that we're seeing consolidation at the top of emerging technologies, which is the companies that have the mass, the volume, and the data will continue to grow bigger. And you'll have those, newcomers and competitors at the bottom. But I see a continual squeezing of the middle market, middle retail, and the middle class consumer.